Thank you very much. It's a pleasure to have been asked to give the Zurich lecture. I can't help but note the timing or the placement of the lecture at the end of the day. So many of the things that I intend to talk about have been spoken about already. That will not stop me. It does inhibit my ability to be original. It enables my ability to be brief, and I will try to do that. I notice also that the wine was passed around prior to the lecture rather than after. So I think people were anticipating a dismal economist and needed their mood lightened, and I will not disappoint. So the title of the talk is The Future of Money in a Divided World. The day has been spent clearly talking about our divided world. I've heard a little bit of discussion and can infer that you've had more discussion of deglobalization, decoupling, and so forth. I think it's clear that the coupling between the United States and China is loosening. U.S. imports from China have been falling quite noticeably. I'm having trouble seeing my own small print here, down by 27% over the most recent 12 months through September, and the same is true to a somewhat more limited extent in the other direction, that China's imports from the United States have been falling as well. So these observations are consistent with the more general phenomenon that we call friendshoring, that in the period, say, leading up to 2017, geopolitical distance between countries had actually been, countries are now importing less from others that are geopolitically distant. So you can see that here in the comparison with the earlier period, 2013 through 2017, and the more recent period, 2017 through 2023, that imports from geopolitically distant countries have been falling, both in the case of the United States and China. It's conventional for political economists to measure geopolitical distance by the alignment of votes with here either the US or China in the United Nations General Assembly. So that's what is being done in this figure, notwithstanding my reservations and other people's reservations about how meaningful that measure is. And you can see the same kind of phenomenon, at least for the United States, not only for friendshoring, but also for nearshoring. So in this figure, I show you average physical distance of source country of imports by value for both the US and China. You can see how the United States is importing more from countries that are relatively nearby. And interestingly, how the same has not been true for China, which is trading more with Africa, trading more with Latin America, trading more with extra-Asian sources. So there is some evidence then of decoupling, of nearshoring, of friendshoring. And you can see evidence of the same kind of fragmentation on the financial side. So here I show you foreign direct investment, Chinese FDI in the United States at the top, and US FDI in China on the bottom. There seems to be, if you will, a collapse in two stages where bilateral FDI began to fall during the first Trump administration, and that fall then redoubled, accelerated, if you will, again around 2022 with the heightened geopolitical tensions between the two countries, new US review procedures on Chinese investments in the United States. So these numbers on bilateral FDI are now pretty close to zero. It seems to have more or less disappeared. More generally, we know, courtesy of International Monetary Fund research and other research, that political tensions are a powerful driver of financial flows, not only of foreign direct investment, but of portfolio investment flows as well. So the IMF's research from a couple of years back suggests that a one standard deviation in geopolitical disagreement between two countries, again measured by disagreement in United Nations General Assembly voting, as happened between the US and China after 2015, reduces bilateral financial flows by about 15%, and that's true of portfolio flows as well as direct foreign investment. So these are signs of fragmentation or decoupling between the US and China, both on the trade side and on the investment, foreign direct investment, and portfolio investment sides. So that brings me to my topic, which is the implications for the dollar and the international monetary and financial system more generally. The dollar, as we've heard, and as the poll question just reminded you, is the currency of the United States, but also the world. And it's important in order to gain a perspective on the poll question that was just asked, to remember the extent to which this is true, the extent to which other countries use dollars not only in their trade with the United States, but in addition amongst themselves, that a majority of global exports and imports are both invoiced and settled in US dollars, that the dollar is the dominant currency in international banking, that the lion's share of international and foreign bank loans and deposits are denominated in US dollars. The dollar is on one side of fully 90% of foreign exchange transactions worldwide. More than half of the foreign exchange reserves of central banks and governments around the world are held in dollar-denominated securities and deposits. This disproportion, if you will, between the size of the US economy, which is considerable, and the global footprint of the dollar, which is even more considerable, is, I think, fairly straightforward to understand. It's rooted in history that the United States was the dominant economic power and trading power coming out of World War II. It was the only country with deep and liquid financial markets open to the rest of the world. So the dollar was, we talk now about whether there is an alternative to the dollar, and there may be or may not be, depending on to what extent other currencies aspire to substitute. But there's no question about the fact that there was no alternative 50 or 75 years ago, and history casts a long shadow that once people get used to using dollars in cross-border transactions, they continue. Once their counterparties, their trading and financial partners use dollars, it becomes more difficult and costly for any one player to shift to an alternative currency. So the dollar's dominance reflects the fact that the US is the single largest economy in the world, depending on how you measure things, certainly at current prices and exchange rates, that the market in US Treasury bonds remains the single largest and most liquid financial market in the world, and then there is that long shadow of history, the fact that the dollar's dominance feeds on itself. So this situation confers considerable advantages, in my view, and it will become obvious, if not in the talk and the Q&A, that my view is not universally shared in, for example, the White House. My view is that the dollar status does confer considerable advantages on the United States, that US banks and firms enjoy the convenience value of being able to do cross-border transactions in their own native currency without having to hedge by financial hedges against currency risk. The US government is able to borrow at lower interest rates than otherwise by virtue of this additional demand out there for safe and liquid foreign exchange reserves denominated in greenbacks. The US enjoys automatic insurance, or at least did up until April 2nd, such that when a bad thing happened to the global economy, the dollar would strengthen. Money would flood into the dollar and US financial markets rather than fleeing them. So when a bad thing happened, even when we in the US caused the bad thing, like Lehman Brothers in 2008, the dollar strengthened in an example of that automatic insurance. And the fact that the rest of the world relies so heavily on dollars means that US financial sanctions are more effective than they would be otherwise. So we can debate about whether the precise way in which the United States has employed its financial weapon has been wise or not. But there's no question that that financial weapon is more powerful as a result of the dollar's global dominance than it would be otherwise. So I would argue this is a happy situation for the United States. It's not so happy for all of the countries that are on the other side of this relationship, and that observation is not new. That's the famous observation of Richard Nixon's Treasury Secretary John Connally, shown you here in the fateful year of 1971, when he notoriously observed that the dollar is our currency but your problem. So this situation has been around for a long time. 1971 is more than half a century ago, and these complaints, as everyone in the room will know, go back even further than John Connally's statement. They go back to Valéry Giscard d'Estaing, they go back to Jacques Rueff, they go back to John Maynard Keynes. What is potentially different is that, unlike the situation after World War II, or even unlike the situation in 1971, there now exist potential alternatives to the dollar. So one widely mooted possibility is China's currency, the renminbi. Another is a network of digital currencies issued by emerging market central banks and traded on a single blockchain or traded on a dedicated platform where they can be directly exchanged for one another without having to go through the dollar and the US correspondent banking system. And since I'm on this continent, there is also the euro, and I will have one very brief slide that has 2 or 3 bullet points about the euro when I get there. Those are the potential hypothetical alternatives. The important point is that actual and hypothetical are not the same. So we heard earlier how China's financial markets are not fully open to the rest of the world, and I would layer on top of that the additional observation that Western governments and central banks are reluctant to rely on the currency of a geopolitical rival, and that private investors may be reluctant to trust the currency of an unchecked authoritarian government. So I've long argued that one of the strengths of the dollar is that the United States is a country of rule of law and checks and balances and division of powers, and that gives it a leg up in currency competition over China. Well, maybe now the tables are more balanced, even if they haven't quite turned. So there are questions about the renminbi. There are difficulties of direct trading between emerging market currencies. India and Russia tried to cut a deal where they would settle their own trade using rupees and rubles. They worked for 2 years and it came to naught. And in terms of that single blockchain or digital platform, I will argue that the technological problem has been fully solved, but the political problem to scaling up that kind of system remains. Having said all that, there has been some decline in the extent of dollar dominance, some gradual erosion of the dominance of the dollar. It's tempting, being in Switzerland, to say the dollar's dominance has eroded glacially. You know, the metaphor means the glacier melts very slowly until the tipping point comes. So it is a metaphor that provokes thought. Here I show you what's happened to the dollar's share of allocated global foreign exchange reserves, and that share has been declining from a bit above 70% of the global total at the turn of the century to a bit less than 60% of the global total now. The dollar has lost 0.5 percentage point of global market share every year over that period, year after year. That's the very gradual, almost glacial erosion of the dollar's share. And if you count up the number of countries that peg to the dollar, that number has been eroding very, very gradually. On other margins, trade invoicing, settlement, etc., dominance of the foreign exchange market, you haven't yet seen much, if any, movement, but I would argue, along with other economists, that these different dimensions of international currency status go together. They complement one another, so I would expect activity on these other margins to follow. Why the dollar's dominance has been eroding is clear to see that the US is not as dominant a force as a global economic power and trader as it was half a century ago. There are worries about US indebtedness, about the sustainability of US government debts and our ability to get our arms around that problem of debt sustainability. There are worries about Federal Reserve independence. There are worries that the US has recklessly and excessively weaponized the dollar. There are some outlandish proposals associated with prominent economic figures within the Trump administration to tax foreign holdings of dollars, especially those of countries we don't like. Most fundamentally, in my view, and I can come back to this if there's a demand, there are worries about rule of law, separation of powers in the United States. Will the country remain, will it be well governed in the future? And there are worries about US geopolitical alliances. Central banks and governments hold and use the currencies of their geopolitical partners because they want to show good faith by holding their currencies, because they regard those partners as reliable stewards of their reserves. So if you threaten your partners, raise questions about the NATO alliance, you're implicitly weakening support for the dollar. There's rhetoric versus reality. So the Trump administration recently has said that it values the dollar's international role. Out of the other side of its mouth, it says it wants a weaker dollar. So how can both things be true? I think the answer is they can't both be true. We are all trained to look for a coherent underlying model for such statements, and we may be in a world where or in a situation where there is no coherent underlying model. So if not the dollar, if the dollar's role continues to erode either very gradually or at a faster pace, who or what will benefit? Here's my list of candidates: gold, the euro, the Chinese renminbi, other non-traditional reserve currencies that have not long been on the radar of central banks and other international investors, and a network of interoperable central bank digital currencies. Those are the options I see. My view is that all of these options have serious limitations. None of them can fill the dollar's shoes, if you will, were the dollar to step out of them. Back to gold, there has been much talk about this. I infer there has been an especially large amount of talk about this in a gold refining country like Switzerland, and you can see here the relative importance of foreign central banks holdings of US Treasuries and of gold. Both of these numbers are somewhat dubious because not all central banks report fully what they're holding, but you can see the trend that holding gold and vaulting it at home makes it safe from garnishment, and it can't be frozen. Russia, not surprisingly, repatriated its gold from the West at the time of its annexation of Crimea to insulate it from sanctions and seizure. Problem being that gold is clunky, very difficult to use to settle merchandise trade. It's very difficult to use for financial transactions as collateral. You can't lend it unless it's vaulted in London or New York. So China is working to change this by establishing a gold repository in Shanghai, but it isn't there yet. So the trend in terms of gold is clear, but gold cannot replace currencies in the international domain. The euro was created in part to create an international alternative to the dollar, but this figure from the European Central Bank's annual report on the international role of the dollar kind of looks like the electrocardiogram of a dead person. It doesn't move around very much. At first, there were existential doubts about the survival of the euro. Mario Draghi put those to rest, but Hélène talked about the importance, other people too, about the importance of completing capital markets union, rectifying the problem that there is a shortage of safe assets denominated in euros. Only 3 euro area sovereigns with AAA ratings from all the rating agencies. Last time I looked, no euro area treasury, fiscal policy, significant fiscal capacity at the euro area level, and little ability to project power internationally. So to elaborate what Hélène said earlier, one of the prerequisites for international currency status, in my view, is security. The recipe is size, stability, liquidity of your markets, and ability to defend yourself in your borders. And I think the security element we have seen all through history to be strongly associated with international currency status. So the euro may become more of a player over time, but there hasn't been much movement in this direction yet. The Chinese are actively promoting the renminbi as an international currency, and they too see a potential opening here as a result of new doubts about the dollar. A first observation is that the renminbi is starting out way, way behind the dollar. So there's some figures here that its share of international reserves is like 2% versus the dollar's 58%. Its share in global foreign exchange transactions is barely 10% that of the dollar, and so forth. So its importance along these different dimensions will have to grow at double-digit rates for decades before it comes within hailing distance of the dollar, assuming the US doesn't do something fatally wrong. And why this disparity exists is no mystery. The United States has been actively promoting internationalization of the dollar since 1913. That was one of the motives for creating the Fed. China has been actively promoting renminbi internationalization for at most 15 years. So we've been at it a whole lot longer. They have a long way to go. And if you look at the data, not widely appreciated, renminbi internationalization seems to be stalling out. The currency's share in global reserves has stopped rising. It's now falling, and the same is true of payments through SWIFT, same is true on global foreign exchange markets, etc. Maybe because of slower Chinese growth, maybe because of geopolitical tensions, maybe because of China's own debt and financial problems, maybe because of those questions about China's political governance that I raised before. So too many figures, too many slides, not enough time. The point of this one is that the renminbi does play a role in China's own trade invoicing and settlement but it plays basically zero role in trade invoicing and settlement among third countries that are not directly engaged in transactions with China. And if you try to reconstruct, as my co-authors and I have, who exactly depends on the renminbi, who holds it as foreign exchange reserves, the answer to a first approximation is Russia. That's the blue slice of the pie. Pie for 80 central banks around the world that report this to the IMF or report it annually in their annual reports. So there's Russia. There's some surprises here to my mind. Switzerland is number 3, according to the data that I have. So I look forward to the dinner conversation to learn more about what has been going on here. The point about the importance of geopolitical links, the fact that Russia holds the currency of its alliance partner, or at least of a country that is studiously neutral in the conflict between Russia and the West, that is consistent with consistent with a long-standing historical pattern where countries hold as reserves and use in payments the currencies of their alliance partners. So the article at the bottom with my co-authors looks back at that history all the way back to the Triple Alliance and the Triple Entente before World War I, where you can see exactly the same pattern. A few words about non-traditional reserve currencies and then about central bank digital currencies, and I will conclude. The dollar has lost upwards of 10% of its global market share in the market for foreign exchange reserves over the last 15 or 20 years. A quarter of what the dollar has lost has been gained by the Chinese renminbi. But 3/4 of what the dollar has lost has been gained by non-traditional reserve currencies. So these are the currencies of generally small, open, well-managed inflation targeting countries. The New Zealand dollar, the Australian dollar, the Canadian dollar, the Singapore dollar. Why they're all named dollars, I'm not entirely sure. But if they're not named dollar, they tend to be named krona, the Swedish krona, the Norwegian krona, the Danish krona. And there is the Swiss franc hiding there, where if your eyes are good, you can see that it has a small share in global foreign exchange reserves, but the simple fact of the matter is there's not a lot of Swiss government debt out there. That was pointed to as a strength of Switzerland in the last panel, but in terms of the country being an international monetary player, it's something of a limitation. But the general point is that the development of electronic financial markets, platforms on which you can buy, sell, hold, trade these currencies of smaller countries, has enabled central banks and corporate treasurers and others to diversify their reserves in the direction of these currencies. Their share has risen, but even collectively, they lack the scale to substitute significantly for the dollar. Finally, what about a network of interoperable central bank digital currencies? So central banks around the world, with the People's Bank of China being an important first mover, are piloting central bank digital currencies, cryptocurrencies issued by the central bank that are as good as any other form of central bank money. The problem with them at the moment is that they can only be used in country. China's central bank digital currency can only be used if you're resident in China, with very few exceptions. How can they be used across borders? One can imagine linking the central bank digital currencies of 2 or more central banks. They could all run on a single permissioned blockchain, a blockchain where only the central banks could validate transactions, or they could exist on some other kind of firewalled digital platform where they could be exchanged directly for one another without the need to go through the dollar, the US banking system, or SWIFT. So we have a good example of this kind of platform already, Project mBridge, which is a project of 3 Asian countries, 3 Asian monetary authorities or central banks, and 2 Middle Eastern central banks. The Saudis have joined the UAE. A limited number of transactions have been made through this platform. There's no technical obstacle, it would appear, to scaling it up. But as I said before, I think there is a political obstacle. The question is, how do you organize regulation and governance of this platform? So the participating central banks will have to agree on who regulates the operation of the platform. They will have to agree on who to admit as new members. They will have, the 5 of them have made decisions by consensus. If there are going to be 25 central banks instead of 5, they're going to have to have a voting rule. Will it be 1 country, 1 vote? China is unlikely to prefer that option. Will it be weighted voting as in the International Monetary Fund? What will the weights be? There's a steering committee for Project mBridge, but no specifics on how it will operate. So, and moreover, I think it's unlikely that the United States or any other Western country will be willing to join. What is a People's Bank of China-led project? So the code was written in the Digital Institute of the PBOC. The protocol that validates transactions, the so-called dashing protocol, was written in the Digital Institute of the PBOC. Would the Fed and the US Treasury be comfortable about US banks or even the US Central Bank participating in this system? So I would imagine Project mBridge becoming more important in a financially bifurcated world where the decoupling that we talked about before went considerably further, and Asia, together with energy suppliers to Asia in the Middle East, agreed on further developing this platform. So if none of the above alternatives can fully substitute for the dollar, what happens if there really is a crisis of confidence in the dollar? I'm not predicting necessarily a crisis of confidence, but we have to think about scenarios and alternatives. Central banks are going to, if they want to reduce their dollar risk, and there are not a lot of alternatives to the dollar, the answer is to hold fewer reserves overall. They will do so by winnowing down what they refer to as an investment tranche of additional reserves that they only need under truly exceptional circumstances. Holding fewer reserves in the end will be less capacity to intervene in financial markets and foreign exchange markets. It will mean, other things equal, more volatility and greater expense of financing cross-border transactions of all kinds. So a true full-blown crisis of the dollar would be a threat to globalization, 21st century globalization, as we know it. And we have to hope that the United States, as well as the rest of us, understand this reality and that they remain good stewards of the dollar. So I've kept my promise about being a dismal economist, and I look forward to the conversation.
Thank you so much for that, Professor Eichengreen. I think we all strongly disagree on that final point. Let me ask you about the fact that there have been rumblings about a BRIC currency that could rival the US dollar. Now, obviously, in terms of the liquidity, the depth, I don't know, Mr. Rajan, maybe you agree or disagree, maybe that would work. But do you think that could be a viable alternative?
No, I do not. think about the euro and all the teething difficulties that the euro experienced in its first 10 or 15 years. Think about the laborious negotiations stretching over really half a century that led up finally to the consensus to create the euro. Now imagine the same issues or problems for a collection of even more heterogeneous countries, even more heterogeneous economically, financially, and politically than the members of the euro area. So I think the BRICS are right to search around for alternatives, to think about whether they can create a digital platform where they can use their central bank digital currencies for direct local currency settlement. But I think BRICS currency is political fiction, social science fiction, if you will.
Mr. Rajan, I'd be curious to hear your thoughts about it later, maybe over dinner. Now, you recently wrote in the Financial Times about the demise of the dollar, pretty much summing up, and with lots of history. For everyone who hasn't read it, please do go and read it, because there's lots of interesting historical nuggets about the rise and now the demise of the dollar. Yet, in the end, you say, and this very much struck me, you said that at the end of the day, the fate of the dollar depends on the rule of law and whether that's upheld in the US. Do you think it will be? Can we trust the institutions to do their job in the US?
So I'm an optimist by temperament. You could undoubtedly infer that from the talk. I try to keep my sense of humor at a minimum, but any thinking American would have to admit to being deeply troubled by what's going on in the country. And you would have to be a better prognosticator than I am to have a clear view of how all this is going to play out. Were the state and local elections that occurred on Tuesday an important indicator of what will come next politically in the United States? Who knows?
So you don't have trust in the institutions in the US?
I'm only going to repeat what I said before, that I'm deeply worried about the strength of those institutions and about the threats they are currently under.
Does that ultimately mean that the US is no longer a trusted trading partner, a trusted ally?
I think the trust that the US commands from its geopolitical partners and its trading partners has been eroded by the events of the last year and to some extent events that preceded the year of 2025. I don't think there's any question about that. Where there's a question, interesting question for all of us to ponder is how much of the damage to US institutions and to the trust the country commands globally can be repaired. So we can all imagine a political swing in 2028. Again, I'm not forecasting a political swing back toward centrist US president with conventional economic views, but will things return to the status quo ante automatically if that occurs? I have my doubts. We've seen a demonstration that the separation of powers and rule of law are not as robust in the United States as many of us had assumed. And it's entirely conceivable that there could be future politicians or political social movements that challenge those institutions again. And we have learned that they are fragile and their strength is not to be taken for granted.
I hear your points. Let me challenge you on that, though. Isn't the market, at least, and portfolio managers, and maybe even central banks, aren't they short-sighted in the sense that the dollar and the dollar's dominance, especially when it comes to American exceptionalism, and that does show itself time and time again, that they will want to go back into the dollar, and the dollar is regaining strength simply because of its economic dominance?
I argued in my talk that economic dominance is less than it has been in the past, that the Chinese economy is as large as the US economy, larger when measured at international prices. There are questions about the liquidity and stability of the US Treasury market as a result of tighter regulation on dealers and all the additional debt that has been pumped out into financial markets. So there's long been the view that the dollar's position is secure because of TINA, because there is no alternative. But I don't think TINA is to be taken for granted. There is also this scenario where prudent CFOs and central bank reserve managers worry about their exposure to the dollar, so they curtail their holdings of reserves more generally.
Let's get to some audience questions. I do see lots of them. Could we see a co-dominance of two or more reserve currencies? One group of countries primarily using one currency and another group another currency, something like that?
Yeah, we could see something like that because we've seen that in the past. We saw it in the 1920s when the dollar and the pound sterling were both consequential international currencies. The pound sterling being used throughout the British Empire and amongst Britain's other trading partners in Scandinavia and so forth, the dollar being used heavily in the Western Hemisphere and some other parts of the world. We saw it before 1913 as well. So people talk about the gold standard and the dominance of gold as international money before 1913, but currencies were also being used internationally, notably the pound sterling, but also the French franc and the German mark. That kind of multi-currency world functioned relatively smoothly before 1913 because the central banks and governments responsible for those currencies followed broadly sound and stable policies. In the interwar period, that system functioned terribly and collapsed in the 1930s because the issuing entities did not follow stable policies. So is a multiple international currency world stable or unstable, good or bad? The answer hinges on the management of those currencies by the issuers.
You mentioned the word stable. Let me just pick up on that. On stable coins, something that Helen has already talked about, and we know that 99% of stable coins are backed by the US dollar, US treasuries, obviously. So isn't that already the newly emerging reserve currency?
That's a very optimistic take on the effects of the Genius Act and the ultimate use of stablecoins. So, at the moment, we know that stablecoins are mainly used for three things. Number one, as on-ramps and off-ramps to other cryptos. You buy a stablecoin and warehouse your funds there until you're ready to leap into the Bitcoin market, or vice versa. They are used to a limited extent for remittances, and they're used for illicit transactions. So is that the basis for a dominant global currency? I think not. We will have to see them move into the mainstream of payments, and we haven't seen that yet. I have my doubts about whether the Genius Act lays the foundations for them moving into the mainstream of payments. We don't know whether stablecoins will be stable at the end of the day. At the moment, we don't know whether stablecoins will be fungible at the end of the day. So retailers like Amazon and Walmart want to issue stablecoins. Will Amazon coin be usable at Walmart and Walmart coin be usable at Amazon? And which one will you all want to use? And stablecoins are still clunky and time-consuming to use in the international sphere. So you have to take Swiss franc and on-ramp it, upload it to a Swiss franc stablecoin, and then download it to a US dollar. Even for the digitally adept, I exclude myself. That can be a time-consuming, difficult task.
Do you worry about what stablecoins and its emergence and its popularity does to the authority of central banks? Does it undermine the authority?
Well, certainly in emerging markets with significant inflation problems, it will be a source of currency substitution, which will erode the effectiveness of monetary policy. In countries like the United States, I worry more about the potential implications for financial stability. So the assumption in the Genius Act is that each of the 54 potential regulators of stablecoins, the comptroller of the currency, the Fed, 50 national bank regulators, and others whom I've forgotten, all of them will be perfect in their regulation of stablecoin issuers, and we won't see problems like we did in 2023. Silicon Valley Bank failed. Circle, a stablecoin, had lots of its reserves at SVB, and holders didn't know whether they would be able to recover those. The coin went to a big discount. The analogy with primary reserve fund, the big money market fund that broke the buck in 2008, it held its reserves in US Treasuries. That analogy is direct as well. And if there's a run on stablecoins, there will be large-scale liquidation of the US Treasuries that they hold as reserves. So what goes on in the stablecoin sphere may not stay in the stablecoin sphere.
Let's get to more audience questions. Anyone in this room with a question? I see someone here and in the back. Sorry, the young gentleman was first, Joachim, sorry. We'll come later.
Yeah. Assuming, I assume a worst case where the dollar decreases a lot in trust in the near future, what would be possible scenarios?
What would be the possible
scenarios?
Scenarios. Well, I think you're asking about potential triggers for that happening, or about the fallout from the consequences of it happening, and you're free to say both.
Yeah, I think you mentioned potential triggers, so I'd be interested in fallout, hypothetically.
Well, I think the potential triggers center both on U.S. economic and financial policy on the one hand, and U.S. politics, foreign geopolitics on the other hand. So more crazy proposals from people associated with the Trump administration to tax foreign dollar reserves or forcibly convert foreign U.S. Treasury bonds into century bonds bearing an artificially low 2% interest rate, I think could potentially trigger more rapid movement away from the dollar. In the medium term, and the medium term is growing closer every day, there are doubts about the capacity of the U.S. political system, as I said before, to get its arms around what is increasingly looking like an explosive debt to GDP ratio. That plus threats to the independence of the Fed do raise the specter of inflation and dollar depreciation, which can rightly scare international investors. And I think that we have already seen how these threats, especially when they're directed at countries that the US or the current administration views as geopolitical rivals, such countries, including China, have been trimming their holdings of US treasuries. And what has been slight trim could turn into, I'm mixing my metaphors here, could turn into a buzz cut.
Quick one here.
Yeah, so you made a very eloquent case for the importance of the political system and stability for the continued dominance of the dollar. But if you think about the rise and peak of dollar influence, you have two things that I think much closer to the actual functioning of the dollar that basically only registered as a small blip. I'm thinking of 1933, the cut in the gold content of the dollar, and then the end of the Bretton Woods system, both of which I think had we sat on a podium back then, you would have probably said would be catastrophic for the reserve status of the dollar, and which turned out to be entirely compatible with its peak of influence.
So yes and no. The first episode, the 1930s, the dollar's international role did collapse in a heap. So the, if I recall my statistics, the dollar's share of global reserves fell by 2/3 after 1930. So that was a consequence mainly, I think, of three major banking crises that were mismanaged in the United States. But there was also an unexpected devaluation and abrogation of the gold clauses, preserving the gold value of US treasuries. So the dollar's international role did not survive those events, but the dollar gained a second life fortuitously as a result of World War II. So those words should not go together, but in the monetary context, they do. Many wise people were surprised by the fact that the dollar did, however, survive the collapse of the Bretton Woods system. So I'm reminded that the monetary sage Charles Kindleberger said the dollar is done in 1975 as a result of the events of 1971-73 when the Bretton Woods system collapsed. The dollar benefited from TINA, the fact that Germany used, the Bardepot, and the Japanese used capital controls to prevent people from shifting out of the dollar into the only available alternatives. And all that happened in 1971 was that the dollar's convertibility into gold at a fixed price was extinguished, if you will, but the dollar's other values were maintained.
A final question from the audience, and I think this is a very pertinent one. What skills do you think young economists should develop over the next decade? You need to make a good case for your profession here.
What can young economists do that ChatGPT cannot? I think the economics profession is moving, broadly speaking, in the direction of big data as opposed to abstract theorizing. And given the dominance of abstract theorizing for some decades after World War II, I think this rebalancing is a good thing. Unavoidably, I will say, try to develop a historical sensibility, something that you can't gain only in a statistics course, but and something that you have to gain on your own, as opposed to gaining it in business school or economics graduate school or whatever.
Will the best and the brightest economists still flock to the U.S.?
We're doing all that we can to continue to attract them, but we are facing certain political headwinds.
It's not going very well. Switzerland? It's a beautiful place, let me tell you. You've seen this, right? It's never too late.
I'm here today.
We'll take that, and of course, we thank you for your time, Professor, and we honor your input. Thank you so much.
It's fun.